Okay, so the first question is, what is understood by diversifiable risk and an efficient market? Okay, would you expect investors to be remunerated for holding diversifiable risk? Okay, and I think, okay, here they twice they did in. See that? So we're going to go with efficient.
Okay.
All right. Okay.
Okay.
Okay. So diversifiable risk, okay, is defined as fluctuations of a stock's returns, which are due to firm-specific news. Okay, it could be called either firm-specific, unique, idiosyncratic, or diversifiable. Okay, but its fluctuations in the stock due only, okay, to news about that specific firm and not extraneous news about other firms or the market as a whole or the economy. Okay, an efficient market, the efficient market hypothesis, okay, means that competition among investors works to eliminate all positive NPV, net present value trading opportunities, i.e., therefore, securities are fairly priced and they're based on future cash flows, given all information that is available to all the investors. Okay? All right, so those are the two definitions then of diversifiable risk and an efficient market. They then ask, as a subset to number A, would you expect investors to be remunerated for holding diversifiable risk? Okay, and we have concluded, okay, that we would not expect, okay, investors to be remunerated, okay, because in an efficient market, okay, the stocks, okay, are going to net each other out, okay, in the presence of competition in buying and selling the stocks, okay, will net the market out as a whole, so that only those, okay, that that have inside information or that are better stock pickers would do well in an efficient market. Everyone else would expect it to be at the market level. Okay, then we're going to go to B, where it asks us to describe, with the aid of a diagram, okay, the advantages of holding a diversified portfolio. Okay, so we have drawn the following diagram. Where on the x-axis we have the number of stocks, and on the y-axis, okay, we have risk going, let's say, for example, from 0 to 10. And we know that the fewer number of stocks that one holds, okay, the higher the risk of his or her portfolio. Okay, as the number of stocks increases, okay, up till about 30, okay, the risk would go down. Okay, historical analysis would indicate that about 30 stocks might be the optimum size of the number of stocks to hold in a portfolio. Okay, and when you get to number 30, okay, it's not going to do any good in terms of increasing, okay, or decreasing your risk by increasing beyond 30. So in our example, assuming that the market risk, okay, of a market portfolio, i.e. in excess of 30 stocks, let's say, for example, would be 2, okay? In our case, as we go from 0 to 30 stocks in our portfolio, our risk would be steadily decreasing down to the market risk, in our case 2, and once we get beyond 30 stocks, okay, we would not be able to impact any further decrease, okay, in the risk of our portfolio. Okay?
Perfect.
Question number C, in the same question, gets at, okay, the question which we talked about before, of beta. Okay?
Briefly describe.
Briefly described, okay? Briefly described, okay, what is stock beta and how we might estimate it.
Okay.
Okay? The first question they ask is the beta of the market portfolio, and we know that the beta of the market portfolio is 1. That by definition, that is the market portfolio
So
is
on
1.
the graph that we just did, why didn't we put the thing in?
No, that's market
not the
risk.
same. Oh, okay.
Not the beta.
Not the beta.
Okay, all right, okay.
Okay.
Okay, so a stock's beta is the measure of the stock's volatility, okay, or the systemic risk in comparison to the market as a whole.
Okay.
A stock that has a beta greater than 1, the stock is more volatile than the market, okay, and a beta of less than 1, the stock is less volatile than the market. okay? A stock's beta, okay, can be estimated in several ways. The most esoteric way is actually to run an regression analysis, okay, of the stock's returns based on market excess returns or based on the average, okay, return, okay, of the market or of our own portfolio.
It's not asking us to do a regression analysis?
No,
Okay.
okay, all right. However, short of a regression analysis, what one could do, okay, if one wanted to estimate the beta for a stock, for example, one could, okay, get the beta of the industry in which that firm is in. Okay, you would then modify the beta of the industry for that specific company. Okay, by adjusting that beta for the amount of debt that the firm is carrying. Okay, so the more debt, okay, the higher the beta.
Okay.
Right. Okay. Okay. Which then brings us, okay, well, it brings us then to the last question. Okay, how long we might expect for an increase in the firm's debt? An increase, okay, in firm's debt, okay, would, okay, increase, okay, the beta for that stock, because the higher the debt, okay, the more risk, okay, the stock is carrying.
So it would go
okay?
over 1.
Right.
at that
Exactly. Yeah. Right.
point. That's easy.
Okay,
The
yeah.
less risk or the less debt.
Right. Okay. Now here let's not get into this. He's asking for leverage versus unleveraged beta. Well, if he gets, we didn't do that research. If that pops up in Mark 2, we'll come back to it.
Okay.
Okay. All right. So that's the answer to question number 4.
Perfect. Thank you.
Okay. Good.